And we are live.
Perfect. Welcome back to Find My Way Home Live. It's Thursday at 5. We try to go, if not every week, every other week here, and go through topics that are important, questions, problems, issues that buyers are having in the current market. And today we're going to talk about an interesting strategy for coping with high prices, a possible inflection point here in the market, high prices and high interest rates. So, really, those two things combined are causing some affordability challenges and a little bit of an impasse in certain markets on certain properties between buyers and sellers. So this is a strategy that comes and goes when rates are high, especially rapid increases in interest rates, which literally, what is it? Is it 30? The most rapid increase in rates in at least 30, but it may be even 40 or 50 years. So in the last 6 months, we're up 2.5%. That sort of gives buyers whiplash relative to looking at homes in December and saying, what do they cost on a monthly basis, and looking at them today and saying, what do they look like on a monthly basis? And, car dealers adopted this strategy, back in the 80s and 90s of, let's not talk about how much the car costs. People are really worried about what the monthly payment is. Well, on a mortgage, on a house, that's an even more true, and it always has been true. If we look over time, if you just look at home prices and household incomes, it doesn't show the true relationship because it also is impacted by the interest rate, which tells us how much the monthly payment is. So what we're talking about here today is a buy down strategy, specifically the seller buy down strategy that Scott's going to walk us through here, of
Yeah.
a way that sellers can help you get a lower monthly payment without a gigantic price cut, which many buyers would hope to see, and the market's not really warranting right now. So, with that, Scott, why don't you? Do we want to first talk about just what a buy down is, period, and then go into the seller buy down strategy? Or you want to just kind of roll into some of your thoughts?
Yeah, I mean, we're going to cover it as we go down. And well, we can talk about buy downs, and there's a couple of different buy downs, right? There are temporary buy downs, which are allowed in a lot of guidelines. And I talked to somebody the other day, and they actually told me, when I bought my house 15 years ago, the contractor was doing a 2-1 buy down. And like what that kind of means is you have a low interest rate, a lower interest rate for the first year, a higher interest rate for the second year, and a little bit above what the market rate was 3 years ago permanently after the third year, right?
Well, and specifically that 2-1 buy down, for the first year it's 2% lower, for the second year it's 1% lower, and then you go for the remaining 28 years at whatever the interest rate is. So one of the common ways, the person who's telling you that story said, hey, the builder paid for that. So in essence, what happened there? We have 1 year at 2% less interest. The lender received 2% less interest than they wanted or expected, and then 1 year where they received 1%. So 3% of interest didn't exist or didn't get paid to the lender. So someone had to pay it. So in that
Correct.
instance, the builder said, hey, we don't want to cut our price. Let's help you get into the property. We'll pay those 3 points and you can benefit from that in those stepped in basis over 2 years, or 1 year at 2% lower, 1 year at 1%, and then go to the long term. The other way, which you hinted at, Scott, is you can pay for it yourself up front, which sort of defeats the purpose, or you can take a higher interest rate over that remaining 28 years, and the lender says, cool, we'll take a little less in year one, a little less in year two, and then catch up over the remaining 28 years. It's a viable strategy, totally legit, totally allowable. Right now, what we're seeing is not many lenders offer it because there's some logistics on the back end of their part. They have to manage that impound account. They actually set the money aside, and when you make your payment every month, they send a little bit of extra interest off to the lender to make them whole for what they were expecting. So if rates stay elevated for the next 6-12 months, we're probably going to see most lenders offering them. As of today, they don't. So today, specifically what Scott's going to walk us through is a permanent buy
Permanent.
down,
Yeah.
using funds from the seller to permanently buy down the interest rate. And he's going to go through the math of why, in terms of qualifying and in terms of your monthly payment, this is going to be your most bang for the buck, well above and beyond what a price reduction would do.
Yeah, and this is interesting because it's funny, Josh. this strategy only works in certain markets, and it works in really kind of volatile markets where rates are rising really fast. And the last time I brought this out. So what we're sharing today is actually a presentation that I'm doing for several hundred loan officers to help them be aware that this program exists, because this is really about education. There's a lot of moving parts. All parties in the transaction need to be involved. And if somebody doesn't understand it, there needs to be an education process that takes place. So this is actually a presentation that I did to help loan officers understand the sort of what this strategy is. And I think it's a really good idea that you as a consumer or as a home buyer understand this strategy, because you can bring it up with your loan officer. And if you're dealing with a loan officer that just got into the business in the last few years, they've never heard of this, they don't know how to use it, and it's not even on the table. And when I show you how this works, I think you're going to agree that it's a really good thing to know about, whether you can use it or not. If it does work for you, it's very, very beneficial. So what's funny is this presentation, Josh, I actually brushed this off. Last time I did this presentation was in 2018, because from August of 2018 to November of 2018, interest rates went from 4.5% to 5%. And that was a pretty big jump. That was a 0.5% jump within 30 days. People started panicking. We started seeing buyers pulling out of the market or offering below or offering lower prices because they could afford less. And that's really that's an important part of this. The first thing that I want everybody to understand, that when you're buying a home, you're making an offer to buy a home. You are negotiating to buy a home from the seller of the home. Now, that's usually done through your real estate agent. Your real estate agent knows the laws, and they're kind of like your attorney in the case, and you're trying to get the best deal and they're trying to get the best deal. And at the end of the day, you have a successful negotiation. And I've always said that a successful negotiation is when everybody walks away from the table and they all think they got the best deal. And this strategy plays a little bit into that opportunity. So really what we're talking about is right now, affordability is the issue, Josh. So a year ago, on July 20th of 2021, the interest rate was 3.229%, right? And at that point, if you were qualified for a home for $450,000, and that was where your price range is, that was fantastic. On July 20th, the interest rate topped just over 6%. And now, instead of affording a $450,000 house with nothing else changing, you can only afford a $413,000 house. And if you're a buyer and if you're in this market to try to buy, you know that home prices are not going down. If anything, there's multiple offers and there's all cash offers, and these prices are starting to go up. But the seller buy down solution comes in right at this point of the market, Josh. So you said that this is the fastest rates have ever gone up. I mean, I know they made a really big jump last week, but I mean, how high have they risen in what period of time?
Well, yeah, let's put this all into context. So you had talked about 2018, that was one of the bigger jumps we had seen. And if you remember 2013, 2014, the Fed was fighting the effects of the Great Recession. They did their first 3 rounds of quantitative easing. We had got rates maybe on our best days down to about 3.625. If we look at the Freddie Mac Primary Mortgage Market Survey, which is what you're quoting here, probably 3.75 is about as good as the rates got. So they had inched up, and then in 2018 jumped up to almost 5%. So 1.25 jump, but 3.75 up to 5 is about a 25% increase there in the interest rates, maybe 30%. And December So just before Christmas is about when we hit the lowest levels of last year. Interest rates were under 3%, 2.97, 2.98%, and you just
Yep.
showed the number of 6%. So we're back under 6% by most measures for most well-qualified borrowers that are not doing a minimum down with a lower credit score, or buying condos, or buying units, or buying an investment property. Your average borrower with 10 to 20% down, a 750 FICO, and a single family residence is going to be well under 6% right now, but definitely the high fives. So when we look at that, Scott, what's the answer? Rates have doubled in 6 months.
Yeah, and the numbers that we're going to talk about today, the rates are pretty irrelevant. We did go back to historical charts to pull some of these numbers. We're being conservative with some of these numbers. The actual number is not as important as the conditions of the market and the opportunity to use this strategy. So you said this before, what we're really looking for is an interest rate time machine, right? And if interest rates are 6%, we can use seller discount points to go into the interest rate time machine, roll it back to maybe 5.25, something like that. And here's why we do that. And here's why we do this target. So I have a couple of case studies for you that I pulled out of Austin. And then I want to ask you, Josh, what kind of opportunities you're seeing for in maybe a higher cost area. So here's the first case study. This house is in Austin, Texas. There was a recent price reduction from $420,000 to $405,000. So as this home sits now on the MLS, available for sale, this home is listed for $405,000. The seller has already agreed to take $15,000 less than what they originally listed the property for sale at. Now, the very first step that we need to do in order to look at this strategy is we got to try to figure out what the actual value of the home is. Because what we're seeing, Josh, is we're not seeing home prices go down. We're seeing really aggressive home sellers be a little bit less aggressive. Is that accurate?
I would say this, it's a funny market. Sellers are going on 2 years of being in absolute and total control. Buyers had no say in the matter. It was essentially an auction for every property. So some sellers got really aggressive. They just looked around and said, hey, whatever the last guy sold for, I'm 10% higher. And that's not realistic when a market levels off. Now, right now, one of the things, Scott, an important thing for us to talk about is you see the headlines, the clickbait, is the market cooling, market, is gonna crash. What we're seeing is a normalization, and how long this continues and what direction it goes is largely going to be dictated by interest rates, because it's caused by interest rates. That doesn't mean that the home prices having gone up 35-40% over the last 2.5 years isn't important. The bigger part of the monthly payment, because look back to January and February when rates were much lower, they were still in the threes. People were buying and there were long lines, and all of my buyers were crying about it's 20 offers on every property.
Yep,
So
can't get my offer accepted.
The sellers that are super aggressive that think they get 10% more than the last sale are sadly disappointed. The people with nice homes that are pricing right are getting their homes sold and having 2-3 offers and getting to pick and sift through them. And the people who have a not so nice home but still expect to get a nice price are ending up looking at price reduction. So really your bigger question was not why people are doing it or what's happening, is it is happening that some homes are not moving as quickly as they were, and motivated sellers don't want to sit around with their house on the market. They want to move the house. So back to your original slide of what is the win-win proposition for that person to sell their house and for you to buy it?
Yeah, so let me set this up a little bit, just so that this is clear, because I removed some slides out of here that for loan officers it would be more important. But what we're looking at is that original sales price of $420, and we want to know what will the house actually appraise for. Now, if you're a consumer and you go online and you look on Zillow or Redfin, they're going to give you what the home is listed for. So you need to talk to either a loan officer. We have access to tools that can do valuation models, or talk to your real estate agent about sales comparables and see what the house will actually appraise for. What could it sell for based off of the appraised value. So let's take a look at what our options are. So the asking price after the reduction is $405,000, right? So in this scenario, I'm just doing a 20% down conventional mortgage. And what you're seeing here is a little pricing tool that kind of shows what the interest rate is. And so at 6%, that you're not paying anything for this interest rate, your payment is $1,942.54. This is just the principal and interest to make an offer on this house. Now, if you really, really want this house, you can absolutely go in and offer $405,000 and pay your interest rate, and get this house for an under $2,000 payment without taxes and insurance. Or if you want to be extra competitive, you go back to the seller, or your real estate agent goes to the seller and says, hey, listen, if I offer you the original $420,000, but you give me back $7,300 to permanently buy down my interest rate, and you'll see that here in the red, this is the cost for a 4.37 or 5.375 interest rate. My payment now as a buyer is $1,881. So my payment is actually $62 less than if I took a market rate and bought the house at $15,000 lower. Now, where this really gets cool is, first of all, why would the seller give you $7,300? Well, the reason for that is because the seller is making an additional $7,600 that they wouldn't have made if they would have sold the house at $405,000. And so that's how this strategy works. This is one of the lower leverage strategies. Like for every dollar they paid in discount points, like they get $1 in equity. And that's a minimum viable return, I think, on that investment. But what you've done as a buyer is you've now separated yourself. And we're going to talk a little bit about how everybody wins in these scenarios. But let's go to another.
Scott, hold on. I don't want to leave that one yet. I have some comments and things that I want to say. So you're looking at this, and there's something that first jumps out at me. If you're not in the market, which you probably wouldn't be watching this video if you're not in the market, but if you're watching at home and you're in the market, you say, well, wait, they offered to take $15,000 off. This is great that this saves me $60, but why would I pay $7,400 more net than what they're asking for? Why wouldn't, if I want $7,500 in discount points, why wouldn't I just ask for add the 7,500 to the 405? You would. The only situation where you're going to go and say, hey, I want to net you more than what you're asking for, they've cut their price to 405, you would say, I'll go 412.5. But what we're seeing a lot is these homes are slightly above where the market wants to be. They get a price cut, and now there's 3 offers. This makes you competitive if there's multiple bids, but if there's not, you can do a lower offer. You give them full price, hey, what I'm asking for, plus the I'm going to cover my own credit, that $7,500 roughly. So you say, I will give you 412.5, and you're getting that savings without having to go all the way to 420. And that additional $7,500 with current interest rates can save you like another $40. So they get what they asked for the second time around, putting it into the MLS at 405. Or if you do get into a multiple bidding situation, you're now more competitive and can go higher with still having a lower monthly payment.
Yeah, and that's 100% right, Josh. We started this off by saying a successful negotiation is when all parties walk away and feel like they got the best deal. So you're 100% right. You could just raise the offer $7,500 more and then ask them to refund that back to you. But there's not a lot of incentive or anything to gain by the seller doing that. And if there are any other offers, because you're essentially what you're doing in that scenario is you're just offering 405. Right. They're going to net the same as if they sold it at 405. So again, see, this stuff is complex.
It's complex. So Scott, here, let's take a real world example. I have a client, very similar situation. They didn't necessarily, they were comfortable with the payment. They didn't want the buy down. This was a property, a lower price property in Northern California, came on the market at like 235. And no one bought it. They had a price cut. They were down to 215, I think is where they were at. My buyer calls and says, hey, it's been on the market for 60 days, went into escrow, fell out. They have a $20,000 price cut. I want to offer them 215, but I want We went through for them, they needed $9,500 to come in with nothing but their down payment. So it wasn't about buying down the interest rate, but I'm talking about the negotiation here. So they went back and she said, I want $200,000 and I want $9,500 for my closing costs. And the seller said, pound sand, because that's not a win-win. That's I win. I get in with basics. I cut you even lower. But we had several rounds of back and forth, and an excellent realtor representing them, and went with the same attitude that you were talking about, saying, hold on, let's not throw the baby out with the bathwater and go, hey, these guys are turds. Let's go back and forth and say, what do you need? Where do you need to be? And I'm going to go back to my client and see if it works. And I believe we ended up at about $5,000 higher than what they were asking for with the $9,500 credit. And my client gets in with exactly 3.5% down. Payment is totally comfortable for her. So that was a win-win. So you're 100% right, but that is where a professional realtor on your side comes into play, because they're having that interface with the seller's agent, and the seller saying, what's their hot button? Is it, do we close as quickly as possible? Do we net as much as possible? And we run through these numbers. So the number side, your loan officer, Scott, me, whoever you're working with, this is a tool to help you negotiate. How do you get the payment as low as possible with the seller getting what they're going to need to agree to accept your offer?
And this is really a financing strategy, right, Josh? So, we talk about all the time, the reason why we built the Find My Way Home Expert Network is to collect a community of experienced loan officers that are always looking for these types of strategies. Real estate agents may not know about this strategy. They may not have run into this a lot, and they don't do it that often because it's really a financing tool. So your real estate agent may not suggest this to you. It may come from your loan officer. Hopefully, if you have a very experienced real estate agent and they've structured deals like that before, then they're absolutely going to make that offer to you. But if either your real estate agent or your loan officer are unfamiliar with this strategy, you could need to upgrade your team potentially. I mean, we say this all the time. Your options are always limited to the experience and the effort of the people that you decide to work with. And they do, and they do work for you. So let's go on to this other one, Josh, because this one is also really interesting. This one was a $375 to $350 reduction. So the seller out of the gate already is willing to take $25,000 less. We're going to check and we're going to see if the property would appraise. Same type of scenario, 20% down, 6% 30-year fixed. You got a $1,678 payment, or we could ask the seller to pay $8,400 in discount points, get our interest rate down to, actually we're at 5.25%. And our payment again is lower than what our original payment is. And in this particular scenario, the seller is paying you $8,500. They're netting an additional $16,500. That is a really, really strong win-win for that seller. And to be honest, this is closer to the leverage that you will usually see based on, for every dollar in discount points the seller contributes to you, the return that they will get back in equity. This is a lot closer to how most of this math ends up working out. So, again, this is what we said, a successful negotiation is when everybody feels like they walked away and everybody feels like they got the best deal. It's not the only strategy, but as you said earlier, Josh, in certain markets, and definitely in certain markets around the country, under certain market conditions, this is just one more tool that you have in your quiver there, in your arsenal, when you're going out there, because it's not that there's no competition anymore. But this is a really cool way for you to kind of manufacture some distance between you and what all the other buyers in the market are expecting, which is to make an offer on the house at the reduced price.
And Scott, here's an interesting point that I want you guys that are watching this to understand. This really benefits the seller. So as a salesperson, person who sells mortgages professionally for a living, I want to go and explain it to people with listings, because we're saying, hey, you cut the price $25,000, we can offer the same benefit to a buyer with a third of that cut, of 40% of that cut, and find a win-win where everyone comes out ahead. But the seller's agent, the listing agent, the person whose sign is in the yard for the home, rarely controls the financing. You're showing up with your lender in line, with your realtor. So it's almost it's hard for us to get the message out other than to realtors who are working both sides of the fence. If they understand this, how this works for their listing, they're going to be able to understand and explain it to their buyers. And we're not by any stretch sitting here saying, hey, this is the one and only or the best solution for the current market. And you'll notice the examples that Scott gave here. The Austin market is hot. I have no idea where Pflugerville is. I'm assuming it's somewhere near Austin, but it is still a hot market. And yet in that market, because of rates having gone up, because of prices appreciating so much, there are homes for the first time in 2 or 3 years where that selling agent and the seller have tipped their hand that, hey, this didn't sell for what we thought it was. We're open to negotiation. Think about the last 2 years. If you had said, hey, seller, would you like to negotiate with me? It may not be as rude as a middle finger, but you're going to get a response that is very similar to go pound sand. I have no interest in negotiating. I'm waiting to see which supermodel shows up to pick me up and take me out on the town tonight. So we're entering a different market where some sellers, to get the number that is comfortable for them, need to negotiate. So if you're out there looking, if a home's been on the market for 1 day, this is not a good strategy. It's not going to work immediately. But if it's on the market for 2 weeks, if it's on the market for 6 weeks, if they've had a price reduction, these are great targets for this. And you and your realtor are probably going to have to educate the listing agent on why are we doing this and how is this a win-win for everyone.
Yeah. You know, you said a lot of things there that I really kind of want to expand on. And the reason why this is complex and the reason why it doesn't get used a lot is because there's a lot of parties that need to be educated. If the buyer's agent, if your agent representing you's never heard about it, then the lender has to explain this math to you. Then the buyer's agent, then your agent is expected to go talk to the seller's agent, and then the seller's agent is expected to have to explain it to the buyer, or to the seller of the home. So what happens in most cases is, again, this is a financing tool. Your loan officer should be able to explain this, and your loan officer can put together a spreadsheet and show the math and show the numbers and show exactly how this works. Then what you want to do is get your loan officer on the phone with the listing agent, with the agent that represents the seller. That's the best way to approach this, and have them do a conference call with your real estate agent and their real estate agent and the lender, and discuss this strategy and really talk it out, show the math, and give everybody an opportunity to see. You know, another part of this, Josh, is timing has a lot to do with this, because the single most important aspect of this strategy is that the house will still appraise for what the original list price was. And the way that we determine in real estate, the way that the value of the home is determined is it's by what somebody would pay for it, and what somebody is willing to pay for a house in the similar area with similar features, similar amenities within the last 6 months. So right now, we're just seeing these price reductions. So all of our sales comparables are based off of this really hot market in the last 6 months before interest rates shot up. So in 6 months from today, or 12 months from today, if there's been a lot of price reductions and nobody knows about this strategy, you're going to start seeing these home values coming down, and you're going to start running into challenges with getting the appraisal done. So real quick, let's kind of bullet point here how everybody wins in this scenario. So as a buyer, you win, first of all, because your offer stands out. If you can put yourself in the seller's shoes for a moment, that seller, whatever is going on in their life, made a decision to accept tens of thousands of dollars less than what they originally expected to receive. So they're already in sort of this mental state of, I had to give something up. My agent promised I could sell it at this, and now we've got to sell it at this. So you really get an opportunity to turn heads, and your offer is going to stand out amongst any other offers that come in. You're going to get your lower interest rate. You're going to step into that interest rate time machine, and you're going to get the rate we had 2 weeks ago. I guess last week was brutal. So you're going to turn that back, and it's permanent. So Josh, on a scale of 1 to 10, what would you say the probability is of interest rates going down at some point in the future?
99.999%.
Okay, so on a scale of 1 to 10, it's a 10.5.
Yeah. No, they're absolutely going to be lower. The only question that we have is, what does the timeline look? And that's part of the reason why people are a little bit uncertain of saying, hey, our home price is going to come down. Well, if interest rates were to stay at 6% for a prolonged period of time, I do believe they would come down. I don't believe home prices are going to come down because I believe rates are going to normalize. Does normalize mean 3% again? Probably not, until the next crisis. But is a 4% rate, is a 4.5% rate a little more reasonable than where we're at today? And is that supportive of home prices at the levels they are? It would still cool the market off. We wouldn't see the 16, 18% year over year appreciation that we had been seeing, but that's probably what normal looks like. We're in a unique position in the economy right now where inflation is completely out of control. And the Fed allowed that to happen by stimulating too far into the recovery. And what they're going to do is they're going to put the foot on the brake too far into the slowdown. So I don't expect them to reverse course anytime soon, but they will put their foot on the brake way too far into a downturn. And as a result, rates will go and correct course back lower. It's sort of like you when your blind 90-year-old grandma gets behind the wheel and she hits the gas too hard and then hits the brake too hard. That's the Fed trying to drive our economy. It's never the nice smooth drive down the road. So the last few years they've been flying down the road with both feet on the gas, not knowing there's a brake pedal, and now we're dealing with the repercussions of it. But for the last month or two and for the foreseeable future, they're stomping on the brake pedal with both feet. And that's going to have repercussions as well. So in the context of this, where are we going? What are we saying? I think home prices are absolutely going to level off. I don't see another big spurt of home price inflation or home price appreciation. But I also don't see a big downturn either. So that's where these win-win solutions come into play. How do we get the seller what they want and need, and a payment that you want and need that you're comfortable with and that your family can live with? A big thing you see in the paper, adjustable rate mortgages are making a comeback. Would you rather have an adjustable rate mortgage, and if it's 2, 3, 4 years before rates go down, that adjusts up and you end up paying a bunch more money? Or would you rather have some type of fixed rate mortgage like this, where you have the certainty, here's my worst case, and if things go in my direction, like I believe they will, I'll have an opportunity to refinance to a lower interest rate.
Yep. So obviously you get the lower payment, you get the long-term savings. And while this doesn't apply as much anymore when they raise the minimum, the minimum tax deduction, discount points technically can be written off on your taxes. Is that correct, Josh?
Yeah. And
on a
purchase, they're deductible in the year that you purchase the home. So these are a big benefit. So let's say it's a $500,000 home, seller pays 2 points. It's a $10,000 deduction. You're going to know where I'm located when I tell you, because to me, I go, hey, that's 40% of that between state and federal. In Texas, you're just looking at your federal taxes. So it could be anywhere from 20% to 40% of that $10,000 savings in your first year of your taxes. Consult your tax professional so that they can go through your situation. But if you're itemizing, there's no limitation on those deductions.
Yeah. So that's a huge win. The seller wins. We talked about maximizing the sales price, which really just means that they're going to get a higher net. And what this serves as for the seller, and this is really kind of for the real estate agent, is it's a good counteroffer strategy. So in a market where if prices do continue to cool down and a buyer offers a much lower price, then the seller can come back and say, hey, how about if we go back to this price and we offer to buy down your interest rate? It's a potential benefit. Really, the benefit to the seller here is that they take home more money when they sell the home than they would have if they sold it at the reduced price. And this is kind of important. Some of this sounds like it just benefits them, but it really doesn't. So here's a couple things. If you're the buyer's agent, your offer is going to absolutely stand out when you give it to the agent that's selling the home. Now real estate agents make their money off of a percentage of what the house sells for. So if we want to appeal to let's say their capitalistic side, there is an incentive there for them to sell the price. Go ahead.
Hold on. I'll put the kibosh on that one, and I don't mean to be a dick to you on that, but let's be realistic. 2% of $15,000 is $300. I don't know any realtor who's willing to risk their reputation over $300. But what they are very, very interested in, if this lovely young lady here is farming that neighborhood in Pflugerville, she's very interested in not having a lower sale go up as a comp in that neighborhood. So they absolutely want to protect home values in that neighborhood, and it is in their best interest to do everything they can to find a win-win number that's as high as the buyer is going to tolerate.
I'm totally with you. I'm totally with you on that one. There's another figure that real estate agents that focus on selling homes, especially in their neighborhood, which is the list to sell ratio. And they depend on that heavily. And they say, I typically sell my homes for 97% of what we list them for, or 105% of what they list it for. So if they're going in and it's continuously selling for lower than what they're listing for, when they're trying to win that next listing, the seller's going to look at that and say, well, you always sell it for less than what you list it for. So this protects this. Their client is stoked. Oh, I went right to the beginning. Everybody is stoked. The buyer is excited. The seller is excited. And then what you just said, Josh, you're not putting any low sales comparables in that community, which means that real estate agent is helping to preserve the home values in the neighborhood that you're trying to buy in. And that's really
which is good for you, as well as you are now a homeowner in that neighborhood. You want home values as high as possible as well.
Yeah. So that's basically it. And I wanted to celebrate with this last slide because, Josh, this is your favorite picture, and we kind of call you the Yoda because of your all-knowingness. And I just want to know that when you woke up this morning, did you say, all I want for my birthday today is to talk about seller buy down strategies?
That is exactly it. I couldn't wait to wake up. It was dancing in my head all night, like a kid on Christmas Eve, like sugar plums dancing around in my head with seller buy down.
Yeah. So that's it. So happy birthday, Josh. And thanks for
and everyone asking the question. Yes, I am 29 again today.
Again, yes. So if we don't have any questions, we will wrap this up, and just want to say thank you for joining us. Like Josh said, we're here most weeks live, and we're talking about what's going on in the market today, what's happening with the market, what kind of opportunities there are, and really kind of trying to unpack and help you understand this, because you've got to understand when something like housing is in the news every night, if it bleeds, it leads. You're getting clickbait headlines every single time. Headlines are designed to get an emotional response from you. Yes, this is a time of uncertainty. Inflation is uncertain. Recession is uncertain. What's going on with interest rates, there's uncertainty, but there are always opportunities in the midst of uncertainty. And so we're here to really kind of try to bring this information to you in just listen. You're never going to hear us say we know what's going to happen, because we don't. And anybody that tells you that they know what's going to happen, they're guessing, and their guess is as good as anybody else's educated guess. But if they work for a newspaper or a TV station, that's not an educated guess. that's something to get you to read an article so that they can sell ads on it. So, join us every week where we'll have people like Josh, been in the market for 25 years, and we have an entire network of experts that are here to answer your questions. Do we have our, yes. So if you are in the market, if you have questions about affordability, what's going on with interest rates, you want more information on the seller buy down strategy so that you can talk to your real estate agent about it, you can go to findmywayhome.com. You can search by state, and you can find an expert in your area, and you can watch all of their videos and see what they specialize in. And you can determine for yourself whether or not they're somebody that you want to work with. And that is what the Find My Way Home Network is.
And Scott, let's make sure we give a special shout out and thank you to our friend Jennifer Lego, who's here every week. I think we could stream at like 2 a.m, and Jennifer has a permanent YouTube feed to her that everything housing related, she is on it. So appreciate you being here and supporting us and the live stream and everything you do for our channel, for Jeb's channel, and many of the other good real estate YouTubers out there.
Yes. Thank you so much, Jennifer. And thanks, Josh, for making time to do this tonight. And for everybody watching, I hope this was helpful, and we will see you next time. Bye.